So, welcome to our Fiscal Fitness webinar series. And I can't tell you how excited that I am to have Kelly be our first guest. I've never actually met you in person, Kelly, but I've been following you on LinkedIn and following you in magazines that are industry centric for a really long time. And you're such a dynamic personality and such a dynamic professional in the industry. I was thrilled to have you be able to kick off this series with us. So thank you so much for being here. We are going to kind of cover a couple things in the beginning, and then I'm going to turn this over to Kelly. So we're really glad that you joined us, and thanks so much for joining us live and for those of folks that'll be listening to this via recording. The question is, what is fiscal fitness? It's a term that I've seen as I'm doing research, and I'm super dialed into the management side of our business, the business end, the reports, and everything that drives your business. So there's a lot of definitions of fiscal fitness for your business, and we're going to hear a little bit from Kelly's viewpoint on this shortly. But in short, from my perspective, fiscal fitness includes knowledge of what makes your business tick, and more importantly, the accounting measures in place to track these elements. So you could be doing all the right things every day, dialed in, but if you don't have the ability to measure that from an accounting perspective, is going to put you into a dangerous situation. This also includes having a pulse on threats and exact costs that can wedge out pieces of your profit as the environment changes if you're not adjusted or accounted for. So there could be things that happen, you're doing all the right things, but if you're not tracking and measuring, you don't really know when things start to go off balance or when your cost of doing or providing a specific service is not within the profit margin or even profitable in regards to what it may have been 6 months ago, 9 months ago, or even last year. So fiscal fitness is also a plan to continuously improve the productivity and efficiency of your operation and back office management to increase scalability. So don't be hesitant to change out aging products or to automate tedious manual processes. I do a lot of talks about utilizing automation. In this day and time, we need to do more with less resources so that we can increase our efficiency, remain competitive, and be healthy from a business perspective. Fiscal fitness is also planning for predictable growth. We're going to act on informed bets on where you're placing your efforts and capital for maximum growth. Because at the end of the day, we're just not in business to just stay the same, to stay level. We're always looking for that maximum growth with our eye on perhaps our exit strategy. Like where does our business go after this? Are we growing it for a succession plan? Are we growing it for our end game? Are we growing it for the retirement of our dreams? So it also includes not just your daily logistics, your planning, your efficiencies, how to increase your efficiencies, how to identify where you can increase those efficiencies, but also planning for growth and planning for what's next. So my experience as a business owner and leader, a business can't really be fiscal fit without a plan for focus on your people. Right now, we are seeing the great resignation and it's in full swing. And the most likely employees to stay with you are those employees whose resumes that you develop internally. Time spent developing new employees that are replacing fully trained employees would be so much better spent developing your existing employees. So we want to help you plan new associates for growth through this series of webinars. So the learning experience that we've planned for you. So this is the first of many educational pieces that are going to be coming your way to help you in all of these aspects. Depending on how you like to learn and how your schedule allows, we have 4 Fiscal Fit webinars planned for you, including the one today and the next one on August 11th at 1 p.m. Central Time. That seems to be a good time slot for our different time zones. We have at least 5 podcast episodes of MicroKey on Air dedicated to fiscal fitness, with the first one released. Our podcast is MicroKey on Air, as I mentioned, and you can find it on Apple, Google Podcasts, Spotify, and then we also will include links whenever we're dropping a new one. We post those on social media if you're following us on LinkedIn or Instagram or Facebook. Last but not least, we are really hoping that we can reinforce these tips and these tools and this information that we're giving to you on blog posts on microkey.com under company menu. You could select blog, and there's going to be some different areas of the blog. One of them is called the microscope. That's going to, zoom in and help to magnify some of these points specifically regarding our fiscal fitness series. It's going to bring to life to your business these different elements of the fiscal fitness concepts discussed in the webinars and on our podcasts. So we really hope you can benefit from these and will join us. You'll join us on this journey to fiscal fitness. So those are my introductory notes to set the stage. Kelly, would you walk us through your perspective and tips for our attendees and help them to better understand what it means for them to be fiscal fit and how to get there?
Absolutely. So first of all, thank you so much for inviting me. I was really excited when I first learned about your efforts to put this grouping of webinars together, because as you can imagine, and just a little bit of history. So I've been in the industry for 25 years. Most of my time in our space has been either doing business acquisitions or doing some sort of lending, always seemingly from the financial end of things. And now my main role is supporting sellers as they go to market, and we put buyers and sellers together. So as you can imagine, a lot of the things that you have just talked about are topics that I am discussing every day, day in and day out, and with the potential sellers, so that they have some idea in the big realm of things, whether or not their business is ready, if they are prime for a sale, or if they actually need to take some time and get things ready and really focus and hone in on certain elements of their business. And that's what I'm going to go through today. It's going to be quick. I'm going to share a lot of information, and I'm going to give you a little bit of background to be able to relate what I'm talking about relative to activity that's happening in the market right now. But I have to tell you, I want to share this, so I can't wait to get the link, and I will share it on my social media. This is such important information that business owners need to be focusing on, not just when they're ready to sell, but every day in their business. And kind of like what you talked about, making sure that you've got things like financials. And I don't want to get too far ahead of myself, because I will be talking about this in a couple of slides, but financial statements that, boy, is it so easy, especially if you're solely an RMR based company, it's so easy to not pay attention to some of the reporting that should be happening in your business all the time. And I'll tell you, once you have ignored it or just kind of shoved it off to the side for a while, boy, is it hard to get things cleaned up and really understand what's going on in your business. So I am really excited that you are doing this series. Awesome. I'm honored to be a part of it. So if it's good with you, I'm going to jump right in.
Let's do it.
Okay. All right. So this is kind of what we're going to cover today. We're going to go talk about business value. We will talk about your preparedness, or any business's preparedness, no matter where you are in the stage of your business, your overall health. And I'm going to go through some really specific things, and I'll share a few examples with you. what an exit strategy might look like. And then we have a little gift for anyone that, I shouldn't say a little gift, it's an amazing gift that I want to offer to all of the attendees that I think is such a great resource, but you'll have to wait to see what that is. And by the way, if I know a couple of people on the call or on the webinar have to leave a little bit early, you're going to see my email in the lower left side of your screen, maybe lower right, however you're seeing it. Anyway, shoot me an email if you can't stay on until the very end, and then I will make sure to share with you what the gift is and make sure that you get one. Okay, so what we all think about all the time is, what are we worth? What is our business worth if we go to market? Should we expect that it is a business that's based on what's happening around us in our particular geographic region? Is it what's happening in the industry overall? What can we compare ourselves to as far as, well, my business has been in this particular market for this amount of time, and I just heard about a business that sold, and they sold for this amazing multiple. So is that what I'm worth? Well, I'm going to give you kind of some tools to determine whether or not that is the case. But I'm going to talk to you a little bit about what buyers are looking for and what is really attractive. And I'll just give you a quick example. Right now, there are a lot of investors, and that could be an existing company, or it could be a private equity firm, or just a new entrant into our industry that may be looking specifically for a business that's focused on fire. Fire is a really hot topic right now. There is not a lot of activity with companies focused on fire that are selling right now. So it's a hot commodity. Businesses that buyers walk away from. Well, there's the elements that would cause an investor or a buyer to not be interested in a deal are not so much because of the overall deal, whether it's an alarm company, an integration company, a fire company, a company that does all, cloud-based access control, to be specific. It's really what they're walking away from is how a business may be run, how profitable they are. And it could be geographic driven for a particular buyer, but what we're seeing is a lot of activity. It's a great seller's market. There are a lot of buyers out right now. Now, some of them are looking for things that are very, very specific. And so sometimes they may have to be patient in their endeavors, but we do see a lot of really good activity happening. Multiples are good. They are strong. We're not seeing even much change in multiples just based on what's happening in our economy right now. So, which is great. It is great for sellers today. So these are some of the trends in our market, and I want to certainly give credit to Barnes and Associates that gave me this information and allowed me to share it with you. But these are some of the trends that are happening in our space, and this is growth opportunity, growth activity that you may want to refocus or shift a little bit in your business, because this is where we're seeing things heading. So, who knew that and certainly if we look back 5 years, maybe even 7 years, that DIY would be growing at the rate that it's growing now. I mean, 17% is huge. But we also want to look at what has stayed really steady and has had continued growth. And that's the traditional residential and small business, steady growth, 2%. So you may kind of figure out, well, where am I in the age of my business, in the age of my career? And do I want to refocus a little bit? Should I shift a little bit of where we've been to move more to one of these more aggressively growing aspects of our business? Perhaps you have been only alarm and you've never really done much with video, but you've got this captive audience. And now you can go out to that market and say, hey, we've got a video offering to you that we can tack on to what you're already doing with us. And that might be a really good and safe way for you to grow your business a little bit faster. But these are things just to think about as you look at your own growth model and you wonder, well, how can I become more profitable? Well, these are some things to focus on, and this can help get you there. So I mentioned really quickly that you may be an RMR-based business or an EBITDA-based business. And just so that I make sure that everybody understands what the difference is, most alarm companies that are specifically doing alarm business with monitoring, and they have contractual agreements with all of their end users, they typically are selling based on their recurring monthly revenue. And multiples, it's really interesting. Every time I think about this, I think it is very cool, I think, to me to say our industry has had such small changes in variation of multiples and the multiple of what businesses are being bought for in the whole time that I've been in the industry. They have literally stayed in that 30 to 40 times range on most transactions. And really, I think you can narrow it down even more. Most transactions fall somewhere between that 34 to 36 times multiples overall. And that's average. Believe me, there are some that go much, much higher and some that go lower based on size of business and types of installations and things like that. But the RMR multiples for alarm companies have really stayed relatively closely the same since I've been in the industry. The other type of a sale is based on EBITDA. Funny word. It's so funny because my daughter, who is just about to be 13, will hear me say, there is a word that I hear you say all the time, and it's such a weird word. And it's that EBITDA. What is it? Well, we had to go into a whole lesson of what it was, but it's earnings before interest, taxes, depreciation, and amortization. This is how most companies that are being sold based on their revenue and their net income, how they are valued. So that's where I was saying you want to keep really good track of financials so you understand what your EBITDA value would be. And your value, every time we at Davis Mergers look at a new business, we look at it based on the RMR value and the EBITDA value, because in some cases you may think you're an RMR company, but your EBITDA value is greater than your RMR value. And we spend a lot of time working with companies to help them understand where their value is greater. So, but most integration type companies sell based on their EBITDA. Those multiples have a greater range, and we see anywhere really from 4 to 7 times being the average, but we work on transactions where it's up to 10 or 11 times the EBITDA or adjusted EBITDA value. So again, we have, not seen a huge shift in the multiples on that, but there are factors that come into play no matter what type of sale you are. So here's some things just to be thinking about. And this is what buyers look at, what lenders look at. So let's say that you may think you're not a buyer or a seller right now, but you may be looking for some capital to help grow your existing business. So some of the things that I'm going to talk about are going to apply even if you are potentially going to be a borrower. You may be looking for a line of credit or whatever the case may be. So opportunities here, size and fit of your company. It's largely going to be subject to who your buyer may be. So if you've got a buyer, and we have a very long list of buyers that we work with, and they may be looking for a particular size deal in a particular market. Well, you can't change that relative to that particular buyer. You are what you are, but these are things that buyers are looking for. But every buyer is looking for growth opportunity. They want to see what your projections are. They are looking at your revenue year over year, and they want to see what the opportunities are. They also may look at your customer base and say, boy, I've got an amazing captive audience here. So this would be a great fit for my company to go now add one of those growth opportunities that I showed you a couple of slides ago. They definitely want to see projections and backlog. What does your WIP look like? What do you have booked 6 months out? Very important, and an element that if you're not focusing on it now, and it doesn't matter how big your company is, even if you're a 3-man company, for you to keep track of projections is a wonderful habit to get into so that you know exactly what's coming down the pike. So buyers are also going to be looking at new vertical markets, like I just said, kind of thinking back to some of those growth opportunities we mentioned before. They want to understand your customer base. Are you all over the board? Are you focused more on commercial, residential? That's something that they definitely are going to want to understand about your business. I've already mentioned captive audience. They want to understand whether or not the revenue that you're generating today is sustainable. Or what you do is, if it's very, very niche. So I'll give you an example. Right at the beginning of COVID, some manufacturers did all they could do to come out with the scanner that could show whether or not you were running a fever. And boy, buyers that did anything in that realm were all over that. They wanted to get their hands on that. They were paying big bucks for those scanners. But now there's not a whole heck of a lot of value in that same scanner. So if you were lucky enough to get in early on and purchase some of those, awesome. But is that something that was really sustainable? Thank goodness, probably not. That's just one thing though. Look at sustainable revenue, because you're offering cloud hosted services. And that is continuing to grow. That's an amazing growth opportunity, whether or not it's video or access control. And then they're looking at your overall financial health, which we're going to dig into a little bit more. So these are things that I want you to really think about. And hopefully you will at least look at one of these and say, well, I could probably do a better job at focusing on this. So analysis of RMR. If you are an RMR-based company, you should know pretty much every single day where your RMR is coming from. Is it alarm monitoring? Is it test and inspect? Is it a maintenance agreement? Is it video monitoring? And you should be able to prepare a breakdown of your RMR so that you know at any given time where it's coming from. What bucket can you put it in? This is one of the most important things that you should be focused on, no matter what type of business that you are. You've got to be paying attention to this every day. Your attrition is probably one of the best health checks for your business that anyone can look at. So attrition is simply, what are you losing? Buyers, lenders, investors, they're all going to be looking at your gross attrition numbers. So that's what you lost. Doesn't matter what you've gained, what you've lost. Now, they will often look at your net attrition, because they'll see, are you able to replace attrition and then grow above that? But pay attention to what you're losing and why you're losing it. Keep copious notes on this. And then every month, go in and look at, why am I losing? Where are accounts going? Is it because of service reasons? Are people moving? Is it lack of payment? Make sure you're focusing on this and then address it. And you can do that. This is all addressable. Some things you can't control. You can't control if a customer passes away. You can't do anything about that. But if you're losing a lot of customers to moves, implement a move program. Get it in place and work at it, and make sure everybody on your team knows, hey, you've got to let our customers know that we've got a program to cover moves. That's just one thing, but you've got to be paying attention to attrition, because I can assure you, any buyer, lender, investor, they're looking at it, and they're looking at it very early on. Your central station. So if you use a third-party central station for your monitoring, a couple of things to focus on. You want to make sure that you've got an agreement with your central station, that you own your own receiver lines, that you can control them, that if anything were to change because of a sale, or frankly, just because you wanted to, that you have the ability to move the accounts to another central station at any given time. Not to say that you will, you may love your central station, and hopefully you do, but some things that you want to look at. Make sure that they can give you reporting that is necessary to help you run your business. One of those reports is called an add delete report, or an online offline report. This is a report that you should ask for every single month, and you should reconcile the accounts that you have in your billing system with the central station's add delete report. If you canceled an account in your billing, it should be shown as canceled in the central station. Factor in that is you have to make sure it gets canceled in the central station. You don't want to be paying for accounts that you're no longer monitoring. So track that on a monthly basis. If your central station cannot provide you that reporting, you should be asking them why. Ask them if it's something that they can implement so that you can be better prepared in your own business. You also want to make sure that you're tracking any testing. Do you have accounts that send a weekly signal, a monthly signal, a daily test? Track those as well. I encourage you to have some sort of test set up so that you know that signals are still being sent. Not everybody does this, but I do encourage you to consider it, especially on your commercial accounts. Actually, it really doesn't even matter. All of your accounts. It's important that signals are being sent from all of your accounts. And then make sure that you pay attention to your central station agreement. There are some agreements that will have a first right of refusal, and that's in the event that you go to sell your accounts. Do you want your central station to have the first right of refusal? That may be totally fine. But that also will mean that, let's say you go to market and you kind of forgot that they have that, it could really slow down what you end up doing. So just make sure you're aware if that's a part of your central station agreement. So tax issues, liens. So there's a couple of different things that you want to pay attention to here. If you are a business that has a line of credit with a bank, the bank is going to have a lien on your company. That's okay. It's not a negative. You would expect that. It's basically saying if you liquidate for any reason and you owe them money, they get paid first. It's not a negative, and it's something that you would expect to have. If you have liens, though, that are there because you have not paid taxes, whole different story. If you have that and I'll give you one example, and you decide to go to sell your company, IRS gets paid before anyone else does. And they will have to give you a release of that lien before a buyer can actually take ownership of the rest of your company. So make sure you're paying attention to that. It happens. We see it. I've seen it many, many times where the IRS got paid first, and that it's okay. We work with you on that. But you want to be aware of it, because you don't want there to be liens that are outstanding that you didn't realize were there. So you can do your own lien search. I encourage you to do that periodically, at minimum once a year, but probably twice a year, just to make sure nothing pops up. Some manufacturers file a lien, especially if they will allow you, a 90-day delay of payment on equipment that you purchase. So just make sure you're aware of any of that. Educate yourself, pay attention to it. Financial reporting, y'all, I cannot stress enough how important it is that you pay attention. First of all, that you create financial reports. QuickBooks has the ability to do a financial report for you. It's important that you do it. It truly, truly is. And then that you pay attention to it. A lot of companies, they outsource this, and that's fine. Or you may have a bookkeeper that does this for you once a month. Okay, so now you've got it done, but did you look at it? So, quick story for you. There is a company that I have been talking to of late. They sent me their financials. They are an integrator. So, everything we're doing for their valuation is based on that EBITDA number that we talked about. So, I got their financials and I looked at it and I could see that their income at the end of the year was really, they were in the red. They were negative for 3 years in a row. But sometimes that's okay because a lot of companies in our industry, or really in any industry, want to minimize their tax liability at the end of the year. So they will spend most of their cash throughout the year. So to just mitigate that tax amount. Well, this company in particular, they sent me their financials. I started reading through. In 2019, their payroll tax amount was greater than their overall payroll. So we talked about that, and the owner was like, I'm not really sure. I didn't really focus on that. So let's go back and we'll talk to the bookkeeper. And so we did, and we got some explanation of it. There apparently was some rollover from the year before. So we got through that. So then he just recently, in the last, 2 months, we'll say, sent me his 2021 finish with tax returns, financials, and everything. And I was comparing one particular line item in their expenses to the 2 years prior. And in 2021, they were showing 780,000 of miscellaneous expenses. Prior 2 years, they had like 2,000 in miscellaneous expenses. And I pointed it out to him and I said, do you know what this is? Like, do y'all have more of an expanded financial that might have some detail in there? He had no idea. They had turned over a couple of bookkeepers in the last couple of years. He has no idea where those expenses were. $780,000. They ended up the year in the red, but we have no idea what could be considered an add back or something we could put back towards their value that would not be an ongoing expense. But y'all, that is a big dollar amount. And I have to tell you, he was shocked. He is shocked. He's still shocked, I'm sure. You've got to pay attention to financials. I think this is what this whole webinar series is about. How strong are you? And you should be able to see that in your financials. Pay attention to the cash flow, pay attention to the balance sheet. I know I sound like I'm preaching at you right now, and I'm sorry for that. But every time I start to work with a company that is looking to move on to a sale, and we find something like this, it just delays what they're able to do. I don't want you to be caught there. So pay close attention to the degree that you can. Operationally, just make sure that you've got your eye on what's happening, how things are being scheduled, how the people that work for you are being utilized. Are your techs spending their time well? Are you finding that you've got more windshield time than you probably should have because of inefficiencies? So pay attention to it. I assure you, someone looking at it is going to be paying attention to it. Long-term liabilities. Again, we talked about this a little bit before, but let's talk about, bank loans and things like that, things that need to be taken care of and focused on. And sometimes these would be paid at a closing. But if you're not planning on doing anything in your business, you're just looking for your overall health, look at ways that you can really minimize liabilities. And a lot of people got the PPP loan, which was fantastic. It was so helpful to so many businesses. Most everyone has had that forgiven by now, as long as they stayed within the rules of what the PPP was for. But then secondarily, though, there is another loan that the government made available that is a low interest, long-term loan. It's a 30-year loan, and I think the interest is sub 7%, which is great. That's, it's a great help for a lot of businesses. Just pay attention to things like that. Minimize your debt to the degree that you can. Monitoring agreements, service agreements, test and inspect agreements. Y'all, this is your gold. This is your gold. You've got to have agreements with every customer for everything. If it's monitoring, it's central station monitoring. Make sure that you're using a contract that has been reviewed by an attorney, preferably an industry attorney, because this is where your value comes from. Service agreement should be very clear what's included in the service. And do you include a trip charge? And are you making sure that everything that you offer in that service agreement that you're actually providing your end user? So again, a lot of people do service, but there's no agreement. If you're not doing that today, and especially if you're an integrator, this is a great opportunity to add RMR to your business, which is that's a whole new webinar. But adding RMR to an integrator business is just going to make you more valuable. So that's a great way to do it, is through a service agreement. Same with test and inspect. Just make sure, especially if you're doing a fire inspection, a lot of businesses, it's a requirement now. It's a state law that they have to be inspected, sometimes as often as twice a year. But you still want to have a written agreement, a signed agreement between you and the end user that identifies exactly when you're coming and what services that you will provide them throughout the year. So if you're in a state where this is a law, this is a no-brainer. You should absolutely have test and inspect agreements. Again, paying attention to where it falls in that RMR overview bucket. So a few things, and I don't want to spend a whole lot of time on what the negatives are, but I do want to point out things that you should be paying attention to in your own business. Some things you're not going to be able to change quickly, but I want to encourage you to think about them. Especially if you're a mom and pop type business, dependency on the owner, it's almost impossible for you to get away from this. But and what I mean is, you are the owner, you're doing 100% of the sales of the business. You would like to retire. So a new owner coming in is going to look at your business and say, well, gosh, if you leave, how are we going to generate new revenue? Well, if you are thinking about your exit plan, think about adding somebody to your sales team, somebody that you can start to transition that part of the business to. Same if it's operational. If you handle everything in the office, or you do all the technical work, and you are looking at your own exit strategy, start to think about who you can add and start to transition out of the dependency falling on you. It can have a huge impact on what you will be able to do in the future. So just be thinking about it. Make yourself some notes, keep it on a sticky note on your desk, and think about, what can I begin to do so that I can hit my target date of retirement? Or, just you want to sell, maybe you're not retiring, but you want to do something else. So I've already talked to you about attrition. I want to talk about it again because it is so, so important. If it doesn't matter if you are an alarm company and you're putting on 50 new accounts a month, but you're losing 57, you are losing. You are not going to be profitable because your attrition is eating you alive. So pay attention to it, understand it. Any of you, I have a great attrition calculator. It's pretty in depth, but I would be happy to talk through attrition with any of you. So don't hesitate to reach out to me. I kind of like digging into that and helping you to better understand what your attrition may look like. So please reach out. I'm happy to go through it with you. Pay attention to your margins. Are you profitable? Now we're kind of going back to those financials. Definitely understand if you need to raise rates. Are you not charging enough? Especially think about if you've got service people on the road all the time. Have you raised to accommodate gas prices, supplies? You've got to be thinking about how you need to adjust to make sure that you remain profitable. What kind of technology are you working on? If you're an alarm company, do you have 3G accounts sitting out there? Folks, we are getting short on time. End of year is going to be here before we know it, as much as I hate to think about that. But every buyer that is buying alarm accounts right now wants to know, How many 3G accounts do they have left in the market that have not been updated? There are some buyers that say we won't even buy them anymore. A lot of others, you will take a big hit as a deduction for the price on those accounts if they will take them. And then if you are an integrator and you've not moved anything at all to cloud, or you're not doing any type of new technology to make things more efficient for your customers, you need to be thinking about it. There's so many new, amazing opportunities in our industry. And you don't have to look very hard. Talk to your current manufacturer and ask them about new technology opportunities that they've already presented, and look at implementing those in your business. And then lastly, no exit plan. Have you just run things day to day and you think, well, someday? So make sure you're thinking about that, because your exit strategy is what helps you to refocus on your day to day. So you're thinking about exiting. Well, who's going to buy the business? Do you have a successor? Maybe your kids want to be involved in the business. The nice thing about our industry, and something we couldn't even say probably as recently as 7 years ago, is that we had a lot of new technology and we were kind of a forward-thinking industry. Frankly, 5 or 7 years ago, you looked out at a meeting and everybody kind of looked the same, and we were all kind of aging out. Now there's so much new technology with AI, with the video capabilities, and so many new things that you can offer your customers, that it really, thankfully, has opened the door to some kids wanting to take over their parents' business, and they see the opportunity. Or maybe it's employees that say, well, gosh, we've been working with you for 20 years. We'd like to buy your business. So start to think about who's going to take your business over. And then when? Do you have a target date? Maybe it's a particular age. Maybe when is when you can put X amount of money in the bank from the sale of your business. So be thinking about that from a time frame. Take the time to do all these other things that I've talked about, and what Victoria will be talking about in these next 3 webinars, to get your business in order. And then how you will do it, well, hopefully I can assist, but there are people like me, and we can help you to get to the how, to talk about with you, what would you do to take your business to the market? But even if you're not to that point yet, be thinking about really focused on your time frame, and get that exit strategy put in place and live by it. Make sure that you focus on, maybe it's something every single month, and get a good standard operating procedure for any one of those things that I've talked about, or all of them eventually, hopefully, and get them in place so that you're ready to go when your time comes. So kind of wrapping up, this is a question that a lot of people don't think about, but I want you to really just think about what I've talked about today, what Victoria talked about in the opening, and would you be ready? How close are you to being ready? And you may not want to do anything for 10, 15, 20 years, but you want to always be ready just in case. And maybe the just in case is there is an opportunity that comes your way that you never even dreamed of, and you want to be able to take advantage of it because you are ready. So live every day like you're going to sell tomorrow, and do the practices that you need to do to make sure that you're ready. So our founder, Ron Davis, has written a couple of books, and they have so many great tips in them. I go back, I read the book the first time when it first came out. Well, I've read both of his books, but this one, The Start of the Deal, I read it when it first came out. And I have so many dog-eared pages and stories that I went back to, because it has helped me to share, just like what I'm sharing with you today. But we have this from experience with the people that we've worked with and that Ron has worked with for 20 plus years. And it gives you tidbits of information that are just amazing. They're so valuable. It is a quick read, an easy read. There's some humor in it, and stories of what has happened with families when they have gone and made really significant changes in their business. So for any of you that would like this book, please email me. We will mail it to you. So send me a mailing address and we will mail the book to you. It's on us. It is our gift. And most importantly, you will take something from it that will help you to run your business that much better. Here is my contact information. If I can answer any questions for you, I think we're going to go back to Victoria for a minute. But if you have any questions, anything that you'd like to follow up on that I may have talked about today, I certainly will ask that you do reach out to me. I would love to chat with you. And hopefully you've had an opportunity to jot this down if you need it. And I will hand it back over to Victoria.
Wow, thank you so much, Kelly. That was some really incredible information. My favorite part or my favorite line of the entire presentation, live every day like you're going to sell tomorrow, right? Having your house in order. So if that, out of the blue opportunity that you can't pass up just happens to come across your desk, then wow, having all of these things in order makes that opportunity. It could be the difference between you being able to take it and you walking away with more than you ever could conceptualize was possible, right?
Yes. Yes.
Just a couple of things, guys, for MicroKey customers before I go ahead and open it up to some of the questions that you all might have really quickly. So Kelly talked about some really important matrices that you guys should have your finger on the pulse of. And I wanted to let you know, I was writing information down because your existing software solution with MicroKey, if you're one of our customers, absolutely has all of those tools available to you. And I actually speak to a lot of those tools in a lot of our MKU classes, our webinars, our training classes. But just really quickly, in regards to analysis of your RMR, there is a recurring revenue breakdown report that you're going to have the ability to run. Somebody asks you, what's the analysis of your RMR? You click 2 buttons and you're going to have that information. Your attrition, we do your attrition tracking, but super important, guys, like she said, one of the things that they're going to ask you, one of the most important things that they're going to ask you is, why did you lose it, right? So you need to be able to create a story of the why to kind of counterbalance if you do have a high attrition rate. So we do have that available to you in the RMR screen, and there is a table that you can build those reason codes. Now you don't want to have just lost attrition, right? You want to specifically be able to drill down as to why, and then take this information when you guys have your monthly operations meeting or you have your leadership meeting, and take this report, look at those lost attrition customers. Why did we lose it? Is it something operationally that we need to button up? Did we get outpriced? Did we provide poor customer service? Did they move? Like Kelly said, put some programs in place to counterbalance this moving forward in the future. That's how you start to run things proactively. So I wanted to mention that. With the third party stuff, if you are interested, MicroKey does have the integration called MK Synergy that links with, I think we're partnered with 10 large third-party monitoring stations now, and we have a built-in audit report for you that will compare your accounts that are online, offline at the monitoring station with your billing records. Accounts in MicroKey that don't have a billing record that are still online, guess what Kelly said, you're paying for them to be monitored, but you're not billing your customer. So that type of audit is automatically built into that integration for you. So those are just a couple of the things that, so much more in regards to how she said, what she said, providing services and you don't know if your margins are profitable, we have that work order profitability report, that installation profitability report that's going to show you how much it costs you to provide this installation, that service, that trouble ticket, those fire inspections versus what you actually build. And then it's going to show you your profitability. Again, this is a report that you should be meeting with leadership at least on a quarterly basis, but preferably on a monthly basis so that you can pivot and make those adjustments. So this gives you your roadmap to your end game, right? Now it's time to, if you're not ready yet, or if you're planning to get ready, give Kelly a call, talk about what your plans are, where you're at, and then put those pieces in place if you're not ready today, so that you're ready in a year, that you're ready in 24 months. So I just wanted to reiterate that we do have these tools built into the solution, including full accounting going all the way through your GL. So you don't need to drop to QuickBooks for your profit and loss and those types of reports. If you have our complete solution, you do have the ability to run those reports as well seamlessly in one database. So what questions do you all have? If folks want to type some questions, that would be fantastic. And I'm going to go ahead. One other additional note. Please tune into our podcast. I didn't know if you guys knew it, but I'm a podcaster now. We have been kicking this off since January this year. I think that there's 3 episodes or 4 episodes that are released, but we have recorded over 10 that are being edited, and we're, adding some different information at the end of them. So we are hoping to release at least one every month. Sometimes there'll be 2 because we do have a lot of content, and we have some great guests that we've been able to engage with, and more that are lined up to be recorded in the future. So please join us and get some tidbits that can help you on this fiscal fitness journey. Thank you so much for being here.